Sophie. I couldn't get onto my I couldn't figure out how to send the link, so I had to messenger it over.
Oh, okay.
How are
Awesome.
you?
Good. So I'm recording right now, but I usually also go live at 7:30. I think there's Andy joining us right now, a little bit early, but there will be more people joining at 7:30.
Okay.
Do you have like a short presentation or something? We can do an interview style.
I think the interview I can go over a little bit about the different type of investing and then just questions because it's going to be such a boring presentation. But I do have like a few pointers that I can share with you guys, and I just have that on a Word document. So,
Okay.
or
Okay.
I can just do bullet points if you wanted me to.
Yeah.
And then pretty much it's going to be more of questions like people can ask us what is what type of investing is passive investing, that kind of thing.
Yeah. Like there's different degree on passive, right?
Yeah, and what are the different types and what are the pros and cons of each one, right? So I can go over I can go over there's practically just like 4 different types of passive real estate investing. So I can go over those 4. What are the pros and cons of each one? And
Yeah.
then they can ask questions after that.
Awesome. Yeah. And I'm gonna ask you a question as well, like when I clarify. So also I'm gonna ask your background and your journey. What's been working for you and what are you focused on right now and things like that.
Sure.
Yeah. Okay. So I think in 2 minutes, well, we can go live in 2 minutes.
Okay. So did you have a chance to answer Tyler?
No, I didn't, but it's
Not yet. Okay.
it's on the percentage on the Excel file that we did.
Oh, he wanted to also know if you're going to maintain that name.
I didn't see that part, but I'll read it again.
Yeah, he wants to know if you're going to maintain the. Anyways, we'll discuss that at another time.
Cool. All right, let me go live on Facebook. Sometimes people ask like on Facebook as well.
I could never get that to work, like being on Zoom and live at the same time. So it's like I have to figure out.
I cannot answer people on Facebook when I go live though. Okay, say them. It's going live stream. It's going live now. Okay, awesome. So hello everyone, I'm Sophie Nguyen. I'm the host of the Monday Real Estate Talk series, and here I am with Kathleen, and we are going to talk about we're going to talk about different kind of passive investing, but also we're gonna ask Kathleen to share her experience with us.
Great. Hi, thank you so much, Sophie, for having me on here.
So can you please tell us a little bit about your background and real estate?
Yeah, sure. Yeah, so I've been doing real estate for 20 years. I started out as an agent working for an online company at that time in 1999, and it was called eRealty at that time. So the very first platform to do online marketing for real estate agents, and I was with them for about a year, and then they got bought out by Prudential, And that's when I decided to leave and to become my own broker. So, so I got my broker license, helping just doing regular real estate transactions, primarily focusing on residential. And then after that, I dabbled a little bit into commercial real estate, but not a whole lot. So I maintained in the residential space. And then about 10 years, 12 years ago, I became a real estate investor. And I started out my investment real estate, journey just like any other real estate investors, right? Primarily just I had a home, we have a home, and then we moved up to a different house. And it made complete sense to rent out the current one that we had instead of selling it. So so we put it on the market as a rental, and we still have this house to this day. And that was, I don't know, 2004 or even before that. So it's been a while. And then from there, we, as a real estate agent, most real estate agents just focus on helping out buyers and sellers, but I've always been interested in having passive income. And so I was constantly looking for ways to have passive income. And the only way I knew how at that time as a real estate agent was to buy more rental properties. And so, and that's how we started, buying rental properties. And then during the recession, right? We had that recession in how long ago was that? 2006, 2005, 2006 was like the height of the market. And right after that, we had a recession. And I was doing a little fix and flipping right before then. Luckily, we got out before we had the major crash. So we got fortunate, we got lucky at that time, although there were a few properties that we ended up not making as much money as, as we were hoping for. And so that crash took place in 2011, 2010, 2011, around there. That's when I also started getting into the non-performing space. So I transitioned from buy and hold, fix and flip, and then transitioning into the non-performing second note space around 2015, 2016, around there. And what I was buying was what we considered as non-performing second. So we are the lender in a sense, and we were buying pools of notes from banks that pretty much were selling huge pool of notes to hedge funds, and then those guys divvy them up and sell them to the smaller investors. And we were buying them in pools, meaning we would get the whole entire package, which included good notes, bad notes, ugly notes, all kinds of different notes in there. So at that time, we had a choice. We could do what we call cherry picking it, but you didn't get a good price when you're cherry picking it. So I was buying in volume. I was buying them in volume because the volume is what actually makes sense when you're buying non-performing, especially non-performing seconds, because non-performing seconds, there's a lot of risk to that. There's a lot of pros to buying seconds, but there's also a lot of risk to it. And then from there, that market kind of dried out. And because I'm also a real estate broker and a real estate investor, and I did not have a huge team, I was able to maneuver pretty quickly and went into a different space. So so I went into lending, doing transaction funding, which is private money lending, and that's to help wholesalers that are like having going through the wholesale space, and they need to close with other people's money. So you hear a lot of investors talking about using OPMs or other people's money. Those were the money that they were using, that myself and my investor had pulled together so we can provide to them so they can do their wholesale deal. And I'm still actually doing that now. So I'm still actively providing private money partnerships. And just recently have been, in the last year, have been looking at multifamily. So realizing that multifamily, just doing the smaller multifamily, the numbers just didn't make sense. And so I partnered up with a few partners, including Sophie and Sasha here. And we decided that the only way to do this, especially with our background in the lending space, was to go into multifamily syndication. So that's where my focus is right now, private money lending and multifamily syndication. Although I still do a little buy and sell traditionally, but that's not what excites me. But that's where the income is, right? So I still do that.
Yeah. So let me break it up. It seemed like you started out as a realtor first, and then you became an investor when you move, and then you keep the house to be a rental, and then start to accumulate rentals. So how may I know a little bit about your rental portfolio right now?
Yes, so we bought and sold. Right now, we we have about 7 rental properties in San Diego, and so we don't have a whole lot because we bought and sold, and also we still have a portfolio of notes that we still notes is when we are the lender, so we have that. So I diversify. So we have single family in San Diego. We don't have any rental properties outside of the state. Just in San Diego alone, and then so we have those that we do long-term and midterm rentals, and then I partner with another group of guys that we do arbitrage of midterm rentals and short-term rentals. So right now our portfolio is primarily just notes and the rental properties.
It's awesome. And then seemed like you remember when Nick Tang was talking, it seemed like the market went through the crash in 2008. And that's why like in 2015, 16, a lot of second mortgage got kind of dumped out by the bank. And
Yes.
that's where a lot of investors got those.
Yes, exactly. So if we were investing at that time, a lot of us were aware of what was going on. There were a lot of first mortgages that were being dumped also. And so there were a lot of first mortgages that investors were buying, like 50, 60 cents on the dollar, depending on where it's at. A lot of them were like in the Midwest, in the Rust Belt area. And then there were, of course, a ton of second notes that were also dumped by the banks because it was crashing. Nobody wanted it. And the second notes, they were selling them for 5 cents to like 20 cents on the dollar, again, depending on where it is. So we're buying them at a very good discount, and that's what makes sense, right? Because there's a lot of things that are involved in working out notes. Notes is especially non-performing seconds requires a lot of due diligence. So it's not like a regular property where you can just go and do due diligence on that property. With buying second non-performing, you have to do due diligence not only on the property but also on the borrower. So you've got two tracks that you're going down, and you got to know how to maneuver that. And if you can figure that out, and you buy them in bulk, you kind of spread your risk out, and the reward is amazing. So I know that you asked me, so of all of the different investments I've done, which one probably has the best return? I would say it would be the second note space. However, being a lender, right? Being a lender instead of a property owner. So one is depreciating asset, and the other one is an appreciating assets. So if you own the property, then of course, besides the rent income that you're receiving, you're also having the benefit of the house appreciating in the future if you hold on to it. Whereas with a loan, any type of loan, when you're a lender, it's a depreciating asset. So as the borrowers pay it down, your value decreases.
Mm-hmm.
Yeah.
So we have a question right here. People ask, what's the first mortgage note and what is the second note?
Okay, so pretend that you are Wells Fargo, right? And I'm buying a house. So I would go and get a mortgage from Wells Fargo from you to buy my house. And that's considered a first mortgage, 80%. Usually they require 80%. Although, you can get less than all of that, but we're going to be, very basic. So that's easy to understand. So you'll get a loan from Wells Fargo. So Sophie, let's do you. So you are a lender, you're Wells Fargo. I come to you as a borrower. I ask you for 80% of the purchase price so I can buy that home, right? So you, Sophie, instead of being Wells Fargo, it's Sophie. Sophie can give me that loan as an 80% lender, okay? And then I put 20% down and I go purchase that home. 5 years down the road, the property has appreciated. Instead of being 100,000, now it's 150,000. I can go and get a HELOC or a second mortgage on that home for, I don't know, usually they do like a total combined loan to value of 80% or even 90%. So you can get another mortgage out of $20,000 or $30,000 as a second position. So you would go and get a HELOC, or they call it a second mortgage, for $20,000 or $30,000 from your equity. You're pulling equity out of your house, and that's considered a second mortgage. So as a second mortgage investor, what you're doing is you are, number one, either creating that second note or you're buying that second note.
Mhm.
If you're either creating or buying. At the time in the 2015, 2016, I was buying, I was not creating it. I was buying the ones that were already created by the banks.
And there's plenty of them for you to buy at a time, right?
At that time, and we were projecting that there's going to be some coming up in the future, but we haven't seen a whole lot of them right now because the whole dynamic of the lending industry is very different, right? In 2005, 2006, or 2000, between early 2000 to mid 2000, all you need to do was to have a social security number, or maybe not even. All you need to do was be able to breathe, and the lenders were giving out the loans without qualifying. They call it Nina loans, all kinds of creative loans that didn't require you to have a lot of documentation. And so at that time, there were a lot of loans that were given out with very low or very little documentation and very little money in. So the borrower has no skin in the game. And as soon as the market crashed, a couple of years after that, the borrower had no skin in the game. So they kind of just left, leave and gave the house back to the lender. So, and that's when the lender had a bunch of mortgages that are on their books that they no longer want. They have to get rid of them.
So seem like you did rental, you did fix and flip, you were doing transaction as a realtor, and you did second lien note,
Mm-hmm.
and now you're doing multifamily, also private lending. So
Yes.
so far, these are different type, and some of them active, some of them passive. What's your favorite so far?
That's a good question, Sophie. I love real estate. So I love all types of real estate, but I started out as an active investor. Now, everyone claims that real estate investing is passive, but really it is truly not, okay? Real estate investing has multiple buckets, and when you're talking to just the general public, they say real estate investing is passive. But if you are a real estate investor, you know that that's not true, right? You have two buckets in real estate. You've got the active bucket and the truly passive bucket. And being a real estate investor, even though you're receiving passive income through rentals, it's an active job. You have to manage the property. You have to fix the property. You have to hire, bring on tenants and hire servicing staff to take care of the property. So it's actually a very active role. You're playing a very active role in real estate investing when you're doing fix and flip and when you are also a landlord. So those, and of course, all the other aspects of real estate investing, which is development and commercial and all that, and we're not even going to touch that. But that's all very active. So for me, And that's considered like being a landlord and doing fix and flip. So that was an active bucket that I was in before. Now I'm realizing that as I'm getting more experienced, I actually enjoy the passive bucket more. And what is that passive bucket? A passive bucket is when you are as an investor, you are a lender, you are a private money lender. Okay, and it's very passive because once you loan that money out to a borrower, pretty much they make sure that you get paid monthly without you having to call them every month, right? As a lender, your borrower has to make sure that they make their payments. It should be their first #1 priority. Mortgages should be #1 priority. Rent may not be. So in mortgages, the borrower always makes sure they pay on time, so you never have to call them. You get paid consistently on time every month, and there's not much you need to do after that. So there's no toilets that you have to clean. There's no tenants that you have to go and recruit into your property, and there's no trash and all of that you have to fix up and repair. You are a lender, so all you care about is your monthly mortgage payment that comes in on a regular basis consistently. So that's truly passive. Now, the other passive bucket that is also a truly passive bucket as an investor is also to invest. And I was going to go over, the 4 different types of truly passive real estate investing. So I guess I can go into that right now. So you've got 4, right? There's 4 buckets. The first one is what we called REITs. So REITs are real estate traded publicly, so they're traded on the stock market, and those are extremely passive also. The benefit to them is that they provide diversification. So when you invest in REITs, you're allowing yourself to be investing in a company or an entity that will provide you with multiple projects over multiple asset classes even. And so your funds are very diversified. With REITs, it's also very liquid, and you have a steady income flow coming in through dividends. And these guys, because they are highly regulated, are very transparent. So you can see their financials and see exactly what's going on with the company.
That's on the stock market, right?
That's on the stock market, yes.
Yeah.
So that's more like stock market, but that's still kind of like real estate investing, but on the stock market. But the cons to that, of course, is that you're on the stock market, so it's going to be very volatile, right? And it's going to be you have no control over that. You pretty much, it's almost like you're buying stocks in a company, pretty much. And the management fee is extremely high in REITs. So your dividend is going to be reduced based on those management fees. The second class of real estate, real estate passive investing is what they call crowdfunding. And crowdfunding is almost like a REIT where they just pool money together. You can invest in small amount. So the pros of crowdfunding is you can invest in small amounts, but again, you have your return is not that great because you're very diversified and you have much higher management fees. So there are limits, there are risks to those type of investing, but it can work for some people. Especially when you don't have a whole lot of capital and you want a smaller amount of money to get into. So the third type is real estate syndication, and that's what you and I are involved in right now, Sophie. And what that is we pool money together as investors, and so as a syndicator, we kind of gather people that we know, and we pool money together, and we do our due diligence on certain specific projects, and we invest in those projects. And even though we don't have a whole bunch of control, like we would if we do just a simple joint venture with one partner, but we do have a little control because we get to do the due diligence. We know exactly what the projects, we know exactly where it's located, what's being invested. And so this gives the investor the ability to invest in larger projects and diversify, right? And that's that's the pros of investing in syndication, is diversification also. But the cons, of course, is now again you have you cannot control as an investor. You can't control what project's being invested. The only thing you can do is, are you willing to invest in the project that's already presented to you? The exit strategy for syndication is a little bit longer than those other two that we talked about before. The other two are a little bit more, especially the REITs, they're very liquid, whereas in the syndication, your time frame is more tied to the project, and so it's a little bit longer. The fourth bucket, which we already talked about, is private money lending. Okay, so that's the fourth bucket that's extremely passive. So if you want to go passive, those are the four areas that you can invest your money into, that you'll have truly passive, where you yourself do not have to get your hands dirty. Okay, so I currently still have active projects. I have 2 active projects right now in San Diego, and I'm not looking forward to those active projects. It's a lot of work.
Would you say note is also very active, or is like half active, half passive?
That's a very good point. That's a very good point, Sophie. So notes is considered passive in a sense that you're getting dividend, right? But if you are a note investor, it is a very active role. It is an extremely active role. It's a business, actually. It's a business that you have to run. And so you have to do, because no one's going to do the due diligence for you. You could hire companies to do it for you, but are you going to trust what they find, right? So yeah, you're right. Being a lender, especially when you're doing private money, you have to do due diligence on it, especially if you're buying non-performing notes. Now, if you are yourself a lender and creating the note, and you've done your due diligence and you've underwritten the note very well, and the borrower and the property very well, once that's underwritten and it's a good loan, then after that, it can be a pretty passive investment, and you just get the monthly mortgage payment that the borrower gives you. But it becomes active again when the borrower defaults, right? So if the borrower stops making payment, now you got to figure out how do you foreclose on the property? What do you do? And so that's where it becomes an active role again. So you have to understand the foreclosure laws. You have to understand, and there's a lot of regulations in what you need to provide, what documents you need to provide to the borrower. That's why we don't work with primary homes, because the restrictions and the regulations on primary homes are extensive. We primarily focus on investment properties, which have less restrictions. And so, but it still requires a lot of due diligence. And depending on, especially if you are a lender, depending on what state you are lending in, you have to be careful on, whether it's a judicial state or non-judicial state. What that means is whether it's a trustee, or when you're foreclosing, whether you're using a trustee to foreclose, or you're actually going through the court system. And if you're going through the court system, that could take a while before you can actually get a judgment to have an auction date. So yeah, it is an active, being a private money lender is actually pretty active. It is pretty active.
Yeah, seems like the more control you have,
the more active you
have to be.
Absolutely. Like, you're right. You're 100% correct there.
So if you do seller finance for a house, you're gonna become almost like a note holder, right? And then if something happened, you're gonna have to go back and foreclose on that house. Even it's passive, you think it's passive, but you have to like equip yourself with all the due diligence, and then how do you foreclose on this house, and what's the worst thing that can happen. And
right, as a new investor, I would never recommend anyone become a lender. Definitely not for a new investor, because there are a lot of different things that you need to be aware of. So be an investor. The first thing is probably own a home first, and then after that, you can work through different types of real estate investing, but being a lender, if you want to get into the lending space, the best thing to do is partner with someone who knows how to be in the lending space. And then maybe after that, you can go off on your own. But I would not recommend anyone starting out being a lender.
Right. So Andy asked, if borrower and bank dump second note, how are you making money in 2016? Did you foreclose on the borrower? And is that why it's lucrative?
That's a very good question, Andy. Yes. So when I bought it back then, the market was still down, right? Nobody wanted those notes. But being an investor, and you realize that you make a lot of your money during the buy, not the sell. So I buy properties and I buy notes, not with the expectation of waiting for it to appreciate, but what is the current value of that note is worth. And so even when we were looking at the value of the property and the note that they were selling, there was still some equity in a lot of those notes that we had. And the reason that we had to buy them in volume is because not all of them have equity. So some of them have equity, but the majority of them do not have equity. And so what we're buying is especially the reason I buy second, and there is an emotional attachment of a borrower to that has second mortgages, right? Usually, the reason I bought seconds instead of first, even though first supposedly has less risk, is because the first mortgages that were being sold at that time were primarily in the Rust Belt states where the houses were not very nice. It was, they had a lot of issues with the house. And if someone defaults in their first mortgage, most likely they're not going to want to stay. So I bought second mortgages because of the fact that most of these properties were nicer homes. They were nicer properties, and the borrower was also financially stronger at the time they got the HELOCs or the seconds. And so being that they were at one point financially well off, it just made sense that they would want to stay in their home. And if they default on the second but not on the first, that means that they want to keep their home. And so we have this, or I was with a group and we had this idea that they're going to want to stay in their home. And so what we did was we work it out with them. So a lot of times, if they kind of bury their heads in the sand and they refuse to talk to us, there's nothing we can do. Then we have to foreclose on them. But if they are willing to work with us, we would do loan forbearance, and that's where we made the money, in the loan forbearance. And some of them would do like a short payoff, which is like a short sale at that time. So even if we, let's say the second mortgages is like the unpaid principal balance is 100,000, right? We would buy it for 20,000. About 20 cents in the dollar, especially in California. If it was another state, we would buy much cheaper. But in California, we were paying about 15, 20 cents in the dollar for the second space, or for the second mortgages. And so most of these second mortgage borrower want to keep their home. They don't want to let go of their home because they have some skin in the game. Because they had at one point they had most likely put a larger down payment than some of the other guys that have no second mortgages. And so they wanted it, they're emotionally attached to their home. And so all we needed to do was offer them some type of forbearance plan, and they're more than willing to accept it. And that's how we make money, is through, so even though we pay 20,000 for that note, but if we're getting, like $1,000, $500, or whatever it is for the monthly income, if you look at the ROI, that's pretty good, right? Because where are you going to buy a house for $20,000 and get $500 a month net in income? Even back then, that was not possible. And now it's even worse. There's no way you can do that. There's no way the numbers make sense right now for that.
Yeah. I hope that answer Andy's question. There's a question from Nyatkom. Could you recommend some reliable platform to start with crowdfunding in real estate? How is the return on investment on this kind of investments?
So honestly, I don't have a recommendation for you for crowdfunding. I know about them, but I do not invest in them myself. And so I would never recommend something that I personally have not invested in. So I know that you can Google them, and I don't know what the return is. I know that it's when I was looking at it back a couple years ago, it was not something that I am interested in. So I don't have that information for you, unfortunately. So
Right.
yeah, I don't believe in crowdfunding, actually. I know that that's one of the passive investment that's available, but not all passive investment is necessarily a good one.
Mhm.
And it's going to be based on your preference, right? For me, I'm more into private lending and syndication. I do not do REITs, and I do not do crowdfunding, because that just does not make sense for me as an active investor.
Gotcha. And she asked, are you buying institutional debt, like bank debt or private money debt?
At this time, I have not been buying any institutional debt for a while. I bought a few pool of notes back in the 2016, 2015 day. But ever since that time, I ran out of money and I couldn't buy anymore. And so, and then when I started having money come back to me, the numbers were not very lucrative anymore, meaning it was too competitive and people were bidding them too high. And the amount of work that you had to put in to make it lucrative was not there for me. So I have not bought pools. I've been buying singlets, here and there, but not pools. And singlets usually are coming from private investors, not institutional banks. So the last institutional banks that I bought was back in 2015. And that was not even coming from the bank. It was coming from the hedge funds or the smaller investors, because as a small investor, there's no way we can touch the banks. They're not going to sell them to us. You can go to community, if you're looking to buy institutional notes, you may be able to go to like the community banks and talk to them. But a lot of these guys, what they do is they package them and sell them to like as a group. They don't want to deal with individual investors, unfortunately, when you buy institutional notes.
Oh, that's what Sasha was asking too. Like, how do you buy these notes, or how to buy institutional debt?
Yeah, institutional debt is possible to buy, but what you do is you have to buy them from a bigger pool, a bigger guy, like a hedge fund. And so back then they would sell like huge chunk to these hedge fund guys, and then they would break it apart and sell them to the smaller I don't know if they are called hedge, they're probably not hedge funds, just a smaller like a group of guys that were buying them in bulk, and they were buying them for like millions and millions of dollars, right? And then I connect with those group, and we would buy them from those group. And oh my gosh, during that time, it was like buying notes with the wild west, because all the guys that were selling to us, there were only a few of them that had access to these huge bundle of notes. And it was a wild west, because there was no regulation. So you were buying them through trust, like relationship, instead of going through escrow. I would never do that again, but that's what we were doing at that time, because it was like the pioneer of note investing in institutional notes. I didn't know what I was doing. So, and all of us were in that same boat. So we would buy, now that I think about it, it was a lot of risk. We would buy these pool of notes, and we would expect the seller to provide the asset to us, right? Because the asset of a note is the actual note itself. There's no real property or anything. It's your promissory note that's signed, and your deed of trust, or your mortgage, whichever state it's in. It's either a deed of trust or a mortgage. That was your collateral. And we were relying on the seller to provide that to us, along with, allonges and things like that, and assignment, when they transfer, it's assignment of deed of trust and all that stuff. And some of them didn't provide to us for months. So we would buy a pool of notes and would not get our asset for months. And we were dealing with that at that time. So it was an interesting time. It's interesting. Now it's a little more regulated. Now you actually go through escrow and there, um, but um, but there's not a discount. There's not a huge discount anymore.
Yeah, I was looking into note when I start like knowing you and Nico, and I started looking into buying second mortgage note, and also joining like a mastermind, a note mastermind, where the guy is, having direct access to the bank, where they sell like each quarter they have tons of note, and you cannot cherry pick them. Usually you have to buy like
In
a
pool.
bunch,
Yeah.
a pool of them, yeah, and some you can cherry pick very, very likely that is not that great. And I was
Yeah.
looking into that, and I saw the amount of work that going into that, because I thought I want to be a little bit more passive as well.
Yeah, it's definitely not a
And I
passive.
look into that, I was like, this is not really passive. It's
No,
a lot
not
of work.
passive at all. Not passive.
Including, servicing company, working with lawyer, talk to the, even the, reach out to the borrower,
Yes.
all of that.
There's a lot of moving parts when you, especially when you're buying non-performing, right? If
Yeah,
you're creating a note and it's performing, it's not so bad. All you need is a servicing company and you're good. And if your borrower is good, you're set. But when you're dealing with non-performing, especially if they haven't paid for like years, right?
yeah,
The notes we were buying, they haven't paid for years. And so we had to work it out. So we had to hire what we call a workout company to go out there, knock on the doors. And then we had to pretty much, besides working with them, we had to work with lawyers to try and go through the foreclosure process. So in the trustee state, when we're dealing with the trustee, it was much nicer than dealing with lawyers. But I'm sure other people have different opinions of that. But I had quite a lot of properties in Florida, and I still actually still have one to this day in Florida that I'm still working on. And in California, if the borrowers bury their head in the sand, we can pretty much get the property back within 6 months, But in Florida, it could take 2 years to even 3 years or even 4 years. So it can drag on for a long time. And you're constantly dealing with the lawyers. So your lawyer fees can be pretty expensive. Right now, I have one where I bought the note for, I think, around 7,000 in Florida, and I'm spending close to 30,000 in lawyer fees right now. So
and what is the value of the note?
the value of the note, I don't have all the data in front of me, but there's still equity in it. That's why I'm still pouring money into it. So at the end of the day, even with that lawyer fee of 30,000 and the note at 7,000, I still will probably like profit about 60,000 from that note.
I remember the story of your second note, where you took the house in San Francisco.
Oh, you heard that one? Oh my God, that one is a good one. So that one is probably, I had two that's that good. That one was probably one of the better ones because it was quick and we made a boatload of money on that one. Unfortunately, the borrower, he just was in denial. He just didn't want to work with us. He just buried his head in the sand. And I think if you hear, if anyone's watching and you guys are borrowers and you're in default right now, do not bury your head in the sand. Work with your lender. Call them constantly, work with them because they will try and find a way to work with you. Whatever it is, a forbearance plan, whatever it is, push for it. But if you bury your head and you pretend that it's not happening, it will happen. And it's exactly what happened. He just kind of like, he was a young guy too. He wasn't even that old. He just buried his head in the sand, pretended it didn't happen until it got too late for us to do anything. And then we had to hire a workout person to come in and pretty much help him move. That's all she did was she came to the door. He answered the door and we told him what was going on. And it was too late for us to do anything for him. And so we practically just packed his stuff in the U-Haul and helped him find another place to move to. He lost everything, unfortunately.
Mhm. And,
So,
how much did you buy it for, and how much did you make after that?
Sophie, that's so long ago. I don't remember, but it was a
But
very
I,
good
I
one.
remember you told me the story, and at that time, I was like, "Oh my
It was,
God!"
yes, it was good. I had a partner because at that time I was pretty new in that space also. So I had a partner, and it was a condo in downtown San Francisco. I think if I remember vaguely, um, right now that condo is probably worth over $1 million, but at that time, I think when we sold it, it was probably around 800,000, and we made over 300,000 approximately, if I remember correctly. So
That's amazing. Like, I
yeah,
don't know why
but
that person
that's a
didn't.
fluke, right? That's not,
Yeah,
it doesn't happen very
that's not the
often.
norm. That's not the norm.
No, it doesn't
Yeah.
happen very often. That's just like, like what they called whatever you call it, a rare situation. The majority of the time when you're buying second mortgages, you're going to get the payment, and that's what you want. You're going to get a really good return on your money on the payment, and you're
Mhm.
buying it for, well, I shouldn't say that anymore because it's not, it doesn't exist as much anymore, right? There's too
Mhm.
much competition now. So no one's buying anything for 20 cents in the dollar. So the last time I checked, which is about 3-4 years ago, they were buying second mortgages, non-performing, close to like 70 cents on the dollar. Okay.
Yep.
60 to 70 cents on the dollar. That makes no sense to me, but people were
Yeah.
buying them. And the reason they were buying them was because the whole note space just exploded and everybody wanted to get into it. But I know that those guys right now are suffering. So some of them are barely breaking even on those, surprisingly, right? I'm wondering why, because they probably didn't realize the amount of work that it needs and the amount of money that they're going to spend to get that fund back. But so
Mhm.
competing with that type of buyer market is too tough. So what we do, being a real estate investor, is you have to be flexible. You got to move where the time is, and hopefully you get there before the big crowd gets in. And once the big crowd gets in, everything is done. It's over. It's over. So
Yeah, I feel it's like the same with Airbnb and stuff like that.
yeah, Airbnb right now, it's over. It's over for Airbnb. Although if you have some good ones, then and you have a good mortgage on that, then you're
Mhm.
fine. But to start up an Airbnb right now, no, I don't think it's a good time at all.
Right. So Tom asked, is syndication a method used for buying commercial properties? And where do we find, if any, open opportunities?
That's a good question, Tom. Syndication can be for any properties, not necessarily commercial. It could be, you can do a syndication to buy pools of notes. You can do a syndication to buy pools of single family homes, or development projects, or commercial retail, commercial warehouse, anything. A syndication just means a pooling of funds together by investors to purchase a certain asset that the group has agreed to do. So that's all a syndication is. And so the one that Sophie and I are working right now, we're doing a syndication for multifamily. Okay. And so that's what a syndication is. And how do you find these syndicators? It's based on relationship, especially if the syndication is a private offering. So there's two type of offerings. There's a public offering and there's a private offering. The public offering, you can probably Google it and you'll see some syndication 506C that's available online. And then you do your due diligence to see if you like the way they are, who they are, and all of that. A 506B, which is more of a private offering, that's what Sophie and I do. That's based on relationship. We have to know you in order for us to present the deal to you. And the reason for that is because our wonderful government wants to protect you. Okay, they want to protect the investors. They want to make sure that the investors are fully aware of the project, instead of investing their money into a project and not knowing what the returns are going to be and all of that. So so it has to be based on relationship.
Mhm. But I want to add to the public offering. You can find them, but you need to be an accredited investor to invest in them, which means that they suppose the government thinks that if you have a net worth of more than $1 million, or you have an income of $200,000, or as a couple, an income of $300,000 a year, you should be more sophisticated in investment. So you can participate in the
offering.
public offering.
Mhm. Yes.
Yeah.
Yes.
And
So
that's
it's kind of ironic, right? So as a small investor, we want to be able to have opportunities to make money, but it's not offered to us. It's only offered to people that already have money. So it's
yeah.
like, how does a small investor become wealthy or invest in real estate? That's the tough part. So to answer your question, to find these syndicators that are out there, network. I mean, this is a group of network that you're in right now. And if you want other type of syndicators or other syndicators, then you may want to attend like meetup groups, real estate meetup groups, and just talk. Just ask around and things like that.
And Leslie is asking, when do you think you should start participating in syndication in your real estate investing journey? Is that like private lending? So should people wait later in their investing career to do so?
To do syndication?
Yeah, to invest in syndication,
To invest in
participate
syndication. Actually, I think investing in syndication is the easiest way to get into real estate. It is the easiest, and especially for newbies. Okay, and this is the reason why I like syndication now. Is because before I would have investors come to me and ask me for projects, and I would never be able to partner with them. But as a syndication, you can partner with smaller investors and newer investors, because really as an investor, someone who's new who doesn't understand anything about real estate investing, what you're doing is you're investing in a project and you're getting information about the project, and you learn from other people. You learn from the people that are running the syndication how the project works. And then you can go out and buy your own property. Or you can continue to be, investing in syndication. But as a new investor, so if you are a brand new investor in real estate, there's two things you need, okay? Or one or the other. You either have to have a lot of time, or you have to have money, right? Either a lot of time to invest in learning and doing, or you have the money and then you don't have to learn and do. You just give to people that you trust. The key point is the trust factor. So you have to find people that you trust. But if you don't have the money, and then you need to have the time. That's it. It's either time or money. And if you have both, that's great. But if you don't have either one, then you're kind of like, I think you're kind of being wishful thinking. Because I have investors that come to me, they don't have the time and they don't have the money, and they want to know how to make money in real estate. I'm like, how's that possible? Because real estate investing takes years to learn. No one's going to give you anything on a silver platter, right? Because it takes us years to learn. And the way that I invest is not necessarily the same way that Sophie invests or the way you invest. And so if you want to be an investor and you're serious about it, then you have to, like dedicate the time to do it. Or if you don't have the time because you're a doctor or a lawyer, you have a business that you're running and you really don't care to learn real estate, then take that money and invest with someone you trust and have them work that money for you, so that you can not only get the return, but also get some equity out of that.
Then,
I don't know if I answered that question. I'm sorry. I don't know if I answered that question or not.
So I think you say that it's good for newbie, but just when you either have time or money to do it.
Yes. Yeah.
So another thing is, if people have money, they'll be like, okay, why should I put in real estate? I should save that to buy my house. I should save that to do, put in stock or something like that.
It's everyone's preference, right? I believe in diversification. So yeah, definitely. My husband invests in stocks, although I try to tell him not to, because he hasn't done that well in stocks, because it goes up and down. One day you make a lot of money, the next day it's gone. So there's no stability in the stock market. Although I have some friends that play the stocks that would completely disagree with me, because they know how to do it. I don't know how they do it, but they know how to do it, where it's giving them, the stability that they need. I'm a real estate person, so I'm biased. towards real estate. And but I do believe in diversification. So I would say if you have a lot of money, diversify. Have some in the stock market, have some in rentals to buy and hold so you can build equity, have some in lending if you decide you want to be a lender, and have some in syndication so that you can experience bigger projects. And you know, diversify your portfolio that way. Now, if you don't have much money and you want to start out, then now you got to do some soul searching and figure out what is your risk tolerance level? Where are you at with that? If you are a control freak and you need to control everything, then don't do syndication because you have no control there. Go buy a property and fix and flip it, and then you have total control there. But if you are willing to, you know, to let go of a little of control and trust other people that have experience to generate that money for you, then syndication is the way to go.
Yeah, so that's great, Kathleen. Thank you so much. That's so clear that you should explain. Yeah, I think the level of control,
Yes.
like how much control you are is
How much
also
control do you
important.
want? Mhm.
Yeah, and how
The more
much
control you
passive do you
have,
want?
the more control you have, the more active you have to become, like Sophie said earlier, right?
Yeah.
You know, there's pros and cons to that. If you want control, then you have to actively work the business. That's it. You have to spend the time, learn, and work the business.
Yeah, but it's also, I think it's like a journey. So for newbie, it's hard. It's like when I was newbie, I want all the control. And then at some point, I feel like I'm stuck at this, you know, fix and flip, like do all this construction, working with like contractor, everything.
Contractors and
I don't know how people
subcontractors.
make so much money out of fix and flip. I feel like I'm so stuck at it. I'm like, I make it, but I don't make like hundreds of thousands of dollars, like, you know, on the internet. I always
Mhm.
make
I think there's
the,
only a few people that actually make that much money.
I
So
make a
you're not the
post.
exception. Only very few. Just like in any business, there's only a few that makes a lot and of money in that.
Yeah,
So.
I feel like everything I do is like, okay, I make money in real estate way better than other industry, but it's still, I feel like I'm still an average person. So I'm looking for, you know, people who really good at things that they're doing, and then try to like align with them.
I think you and I are on the same boat, and the reason for that is because we are somewhat of a control freak, and we don't partner up. Um, in anything, if you're a solopreneur, it's very difficult because you're wearing multiple hats and you're constantly having to change hats, you know, from this hat to that hat to this hat, and then every time you change hats, your focus is not clear, right? And or you become unfocused. And so I think to expand, you either have to build a team, meaning you have to be a really good manager and hire people and build a team and willing to spend the money to build up your team, or you partner with people that are like-minded, not necessarily, you know, doing the exact same thing, but very like-minded so that you can leverage each other. So in order to grow. And I just realized that recently. So I just realized, because I've always been a solopreneur also myself.
Yeah, and some of us also like afraid to partner up. I was like, okay, if I partner with that one, I'm gonna ruin the relationship. I was like,
Mhm.
that's a wrong perception, but you know, yeah, at one point you're gonna have a bigger pain of being a solopreneur, that you need to partner up, to grow bigger, to um
Yeah. So it's
protect.
like I don't want to marry him because I'm afraid we're gonna lose our relationship, right? Same
Yeah,
concept.
yeah, it's kind of like that. Yeah.
So I mean, now I think I'm wiser now, where I'm like, you know, to expand and to scale, we need to partner and we need to leverage each other's skill set. And if we do everything, if both of us are ethical and we're all ethical and we do everything black and white, of course there's always going to be disagreements, right? There is disagreements in everything, but as long as we know how to deal with it and everything's black and white so that there's no misunderstanding as much as possible, then hopefully, knock on wood, that relationship would last for a while.
Right. We have question from Andy again. He asked that for the condo, since you were second note for closing, did you have to pay the first note and then keep the remaining 300K?
Wow, Andy has such good questions. So Andy, the way it works is if I'm a second note holder, right? And when I foreclose on the property, I'm in second position. So there's a first above me. When there's a first above me, I have to take over that mortgage. Otherwise, they can't foreclose on me. So yes, so I have to pay off that first mortgage, and then I take the difference between that first mortgage and whatever the balance is. And so, yes, simply the question is yes, I still am responsible for that first mortgage.
And so a few more questions. Nhất Không said that I missed the name of the syndicator you mentioned. I don't think you mentioned any syndicator.
I did not mention any syndicator. I just mentioned the different type of different type of passive investing that you can do, and they're just crowdfunding REITs and syndicators, pretty much. Private money.
And we mentioned the 506C and 506B,
Yes.
which different because it's private offering and it's public offering. It's a little bit different. Nhất Không. And Andy asked again, what is the average hold time of syndication? Once we buy in, there's no liquidity at all. Only exit is when projects sell out.
Yeah, that is correct. So you get, depending on the syndication, right? Every syndication is different. Not every syndication is the same. The syndication is all different, but generally there is a time frame, and generally it's 2 to 5 years or so, and you will get some dividend. So they'll give you some dividend during the time that you are investing with them, and when the exit. So the exit of the syndicator is either refinance and get a different loan to pay off all of their investors, or they sell them at the end of the project. So again, it depends on the syndicator and what their objectives are. You want to add to that, Sophie?
Yeah. So he asked, like, can you describe the structure of your latest syndication with Sophie? What is PP, leadership side, passive partner side, and how much money was involved for each person? So this is very detailed, and it's a private offering, Andy. So
we can't do this online.
Yeah, we can do this online, but we can do it one-on-one with you to walk you through things.
So Andy, to answer your question, contact Sophie and she can go over the information with you. Because this is a private offering and she has on Facebook, we cannot provide that information.
Yeah. So yeah, I guess that's all the question. Another question. Okay. So Nhất Không asked again, what's the typical initial investment for syndication partners?
Typically, some syndications are 50,000, some are 25,000, others can be 100,000. It just depends on the syndicator and how big the projects are. The bigger the projects, of course, the amount is going to be higher, because there's a limited number of investors that can go into that syndication.
Yeah. And Andy asked, will you be syndicating again?
I'm sure Sophie is too. I am right now. My focus is in private money and syndication. So I'm not looking to do any more fix and flips. So definitely more syndication. And so so our job as a syndicator is to go and look for operators that we trust and we vet, right? So our process is to make sure that the project is viable, that it has good return, and that the operator is a good one. Because I've looked at numerous multifamily projects and vetted quite a few operators. So the key of the success of the syndication is the operator, pretty much. And so that's the person, or that's the group that we have to pretty much do a lot of due diligence on, besides the project itself.
Yep. And yes, Andy, we doing syndication, and the asset class that I think Kathleen and I gonna focus on right now is multifamily. right, Kathleen?
Yep, and we can talk a little about generally, and the reason why. Okay, so I've been looking at multifamily for a while. I would say for the last year, and the reason we're looking at it is because right now, a couple years ago, there were a lot of multifamily syndications happening, and these syndicators were buying properties, you know, while it was increasing in value, and they were banking on the ability to refinance at a lower interest rate. But as we all know, that interest rate is not low. And so a lot of these syndicators are in trouble at this moment. And because I specialize in discounts and buying things, you know, wholesale, not retail, I got interested in the multifamily space, realizing that you know, the next potential group that is going to have major discounts is going to be multifamily. So that's why we're looking into the space. And this is why we're looking for operators that are buying in the space, in the discounted space, and or they're either buying, you know, discounted, or they're buying with seller financing, so that the numbers make sense for us and the investor.
Leslie asked, what class, A, B, or C?
What do you mean by that, Leslie?
What class of multifamily, I think, right?
Oh, the class of multifamily. So the ones we're looking at right now is primarily Class B in Class B neighborhood, and our operator is actually buying Class B neighborhoods, but converting the properties to Class A. So the product that they're generating is very high quality product. So we're in the working class, we're going into the working class neighborhood and providing like the highest quality in that working class neighborhood. So we get decent rent, higher than the average, but not so high that you know, that it's not affordable. So we're providing a better quality product to the working class neighborhood.
So
Such
Kathleen,
great questions.
yeah, that's a great question, guys. Yeah, anyone want to say hi? Show their face as we
No, nobody wants to show their face.
as we go into the closing.
We
of,
should take a picture, Sophie.
Yeah, we should take a group picture. I don't know how
Yeah.
to do that. Sasha, can you help me?
Yeah.
Sasha is my technical
that's
guy.
fine. I got you.
He's your everything. He's your technical guy. He's your marketing guy. What else?
Tom, oh yeah, I can see Chi on a subway. No, are you in
Oh,
Costco?
Costco.
Costco.
Oh, hi, Jeff and Chi in Costco.
Can we get them to introduce themselves, Sophie, and just tell us a
Yeah,
little
of
bit about what
course.
they do?
Yeah, that would be awesome. Yeah, Nhất Không, can you go first?
Yeah, sure. Sorry, I was busy with the baby before. I'm a beginner in this field. I am a software engineer, and I'm trying to make some passive income. Just started. So thank you very much for Sophie and Kathleen for organizing and sharing with us your experience. Love to listen from you guys.
Are you based? Where are you based at?
Currently, I'm in Houston.
Oh, Houston. Awesome.
Houston.
Yeah.
Yeah. Andy, are you here? Can you show your face or talk to us?
He
He's
just
been
likes to ask
typing.
a lot of questions, but he won't
He's
show
been
his face.
typing. Okay. Chi, can you introduce yourself with the group?
Sure. My name is Chi. Me and my husband are Costco lover, and we love spending time at Costco. We're getting a little tired of single family home, so we're wanting to get into syndication and alternative asset.
That's awesome. A little tired of single family house. Cool. Yeah. And Tom, where are you calling from?
Oh, hi everyone. First of all, thank you to Kathleen and Sophie for organizing all of these talks. So it's very helpful. I'm actually based in Austin. Sophie, actually, I just recently became friend with you on Facebook. So I'm a software engineer based in Austin. Starting my journey, it's looking into the real estate investment, totally newbie. So it's very helpful today to hear from all of your inspiring stories and experience. Thank you so much.
We have a lot of tech people here.
I know. Well, Asians, Vietnamese, right? What do you expect?
Right. Yeah. Chloe.
Hi everyone. Yeah, I'm based in New York, and we currently own like just our house, but maybe in the future, after we take care of our babies and we have more time from taking care of baby, then maybe we'll look in more into like investing.
Babies.
But we're thinking of the next house. We want to move back to California. Still New York or California. I know it's a difficult market to invest in real estate. So so it's good. It's good to know that you, Kathleen, that you real estate investing in California and successful. So
Keep in mind the ones I bought are a while ago, right?
yeah.
They don't cash flow anymore. Purchasing right now in California does not cash flow anymore. Very, very few.
Yeah.
Thank you, Chloe. Yeah. Hi, Leslie.
Hi.
Thank you for joining.
Yes, no, thank you for having me. This was really great. I'm very glad to be here. So I'm out of San Antonio, Texas, and my husband and I are owner operators and we're syndicators as well. We were passive for a very long time in the beginning and did very well. And then we became operators at the hardest time ever to switch over to the active side. So this is our first challenging real estate investing season. So now it's just more important to get back to the fundamentals and connecting with people again and showing a couple of steps ahead, but also able to actually show you the challenges that are going on right now. There's a lot of new people who want to come into syndication, and I think that's great. A lot of us who have been doing it for the last few years are very tired. So it's good to have some, just new people joining, and, it's good to see Texas, the smaller groups joining. So there's a lot of opportunity right now, and I, just glad to be here and to connect with y'all.
Yeah, and Leslie, you and your husband also did single family house for a long time, right?
Yes, we did single family for 10 years, and we did it slow and steady in the very beginning. And then we used that to get into multifamily. But looking back, maybe we should have held on to some of the single family right now.
Yes, knowing what I know now.
Knowing so, but
yeah, instead of
the reality is we couldn't make the next move had we not traded, so you have to make that decision, and then you look back, and then you just that's real estate. Now I'm understanding there are more pieces as opposed to like, yes, it's physical property, but it's only physical property for a short period of time, and you have to decide how long you want that stewardship to be and what that's going to look like.
I think I met Leslie at WIMFA last time.
Yes.
Yeah. So like, I think I mentioned the story. You mentioned the story of you and your husband investing in single family. Nice to see you again here.
Yes, nice to see you. I went to WINFA. I drove from San Antonio, so my parents live in San Marcos, and I'm glad all of these are so close. Before it was you had to go to Dallas or you had to go to Houston, or we were so it's really nice to get out sometimes, especially being home all the time and just doing this from home with your husband.
Yeah. So I met Leslie at the women group in Austin. Yeah. So
yeah, I know. I met her in Austin too. Sorry.
Thank you, Leslie.
Yes.
Thanh Bùi, yeah.
Hi, I'm an electronics engineer. I have a single family home, also kind of tired of being a landlord and trying to move into syndication and passive income.
That's awesome. We all
Are you-
like-minded here.
Sorry, can I ask one last question?
Yep.
Is Thanh Bui based in Seattle, or where are
Yes.
you based at?
Yes, this is the same one that you know. We're
Oh,
Facebook friends.
okay. Nice to meet you via chat.
Okay.
Maybe we should meet.
Yeah, they new to Seattle from Austin, so
Oh,
they
I think you
abandoned
have-
us in
I think you
Austin.
have one more. I think you have
We have
Andy.
Andy.
Hi, everyone. I'm sorry, I was driving, so I couldn't switch the phone in time. But thank you, Kathleen. Thank you, Sophie. I was doing hardware design out of Austin, and my journey was I was always a passive investor. So I bought like 9 homes, and I never sold them, so they
Good
all
for
went
you.
up over
Good
time.
for you.
Yeah, but you know what though? I think my mistake was I never leverage. I didn't use bank money. If I did use it, I'll be better off. But so the lesson learned was holding it long term was actually good. The depreciation, the rent increase, the appreciation also. So for any new person, I mean, I thought that holding long term was a gain. However, nowadays, I'm actually interested in the lending part or the multifamily syndication thing. I'm willing to buy into a syndication if Kathleen and Sophie would syndicate. So
That's awesome.
You mean
Yeah.
if we were operators?
you mentioned you had an operating company, right?
No, we partner with an operator. We would never be
So-
operators.
Okay,
I
okay,
would never be an operator.
okay. So you were managing partners then?
Yes, yeah. Well, we're co-sponsor. Yeah.
Mhm.
Awesome,
Yeah.
awesome.
Yeah, but I don't think you'll ever see me being an operator again, like Leslie. She's an operator. I can't imagine being an operator. So
I can't wait till I'm not anymore and go back to the passive side. Just kind
Yeah.
of punching my card for a little while to really make sure that I can rest on the other side a little more.
yeah, and the more you go on the other side, the more you realize that you don't belong there, right? So definitely don't belong in the operation side.
Yeah, I also meditate on that, like, do I want to build a 200 people company or not? That's a different answer, right?
Yeah.
Or I just want to, be passive and a little bit active. Yeah.
Great. Well, great meeting everyone. Thank you so much for your great questions, especially.
Yeah, thank you so
Yes,
much,
that's good.
Kathleen. Thank you so much for everyone participating. Well, please follow Kathleen on Facebook. And if you have any question, ping me anytime, schedule a call with me. If you are newbie, want to buy your first rental, all that, I can, point you to the right direction. Thank you, everyone. And good
Thank you,
night.
everyone. Good night.
Yeah,
Good
thank
night.
you.
Good
Thank you,
night.
everyone.
Thank you,
Good night.
everyone.
Thank you.